Yesterday on the programme we looked at the growing tensions in fiscal and monetary policy between East and West. Despite these tensions, there's never been a better time to invest in emerging markets. That's the message one international expert is delivering at this week's ASFA conference in Adelaide. Dr Michael Power is a strategist with the specialist bank and asset manager Investec based in Cape Town, and he joined me from Adelaide a short time ago. Dr Michael Power, welcome to Lateline Business.
It's nice to be here.
Well, when it comes to emerging markets, you say Australia has a front row seat to the greatest show on earth. What should we be doing about it?
I think there are two things. First of all, the opportunities are good in their own right in terms of what's happening in emerging markets and especially in Asia. And secondly, there are certain conditions beginning to emerge here in Australia with regards to your demographics, which really force you to start looking beyond Australia as the primary repository of your savings.
How much of the growth, Michael, in these markets is reflected in most of the world's capital indices now?
Not at all. I call it the 85-15 rule. 85% of the world's growth in the next decade will come from emerging markets, which currently have about a 15% weighting in most indices. So the paradox at the moment is that investors, when looking at the way the world is, are probably underinvesting in the way that the world is going to be in 10 years' time.
So if I take an example, a fundie, maybe a global fundie, might have themselves rated against, say, the MSCI index, but that's not at all weighted against the growth markets, the emerging markets. So in a way, you could find many of these funds are actually underperforming.
That's absolutely right. Of course, there is a second bite at the cherry that a lot of Australian investors still can get, and that is in buying the sorts of stocks, or many of the stocks that are actually available on your indices. They are themselves directly geared to emerging market growth. So you're not missing out on the story altogether.
So when our fund managers look to investing in, say, European funds, they're not necessarily getting access to the right weighting of growth markets, are they?
Not at all. And I think that the Europeans are facing the same problem as are the Americans. I would actually probably argue on a completely weighted basis, because you have a high exposure to resources. You probably directly and indirectly do have a higher weighting than Europe and the United States generally would have towards emerging markets. However, I still don't think, given that 85% of the world's growth in the next decade is coming from emerging markets, even Australians have sufficient weighting towards that story.
Let me ask you about India, because I was surprised at how quickly India appears to be, on track to exceed China in terms of growth. We've woken up to some extent about China. How much do you think we know about India and investment in India?
Not nearly enough, and I think you raise a particularly important point for Australia. I do think that over the next 10 or 15 years you will find your economies becoming much more aligned, maybe not in terms of character, but in terms of their sort of synchronicity. And I do think that India and the Indian Ocean is going to become an extraordinarily important basin for Australian business and for Australian investments. And I do think you're going to find Australian investors are probably going to do better out of investing in India than they probably will out of China. And that's partly because India itself is, as things are currently constituted, more capitalist than China, though China is becoming more capitalist every day of the week.
Do you suggest that there should be direct investment in a place like India? Because in the case of a fundie, how do you do that? Many businesses in India are family run. There's a lot of corruption we hear about. How do you go about making a good, safe investment?
It's a very good question. I think you're right about the character of private equity investment in India, although I think it's becoming easier, more transparent and more accountable again fairly quickly. It's probably better at this stage to go through the medium of listed equities on the Mumbai Stock Exchange, because there's a certain amount of what should I call it? Proper jurisdiction being exerted by the authorities there on listed stocks. And I think that's probably a safer way to go. Part of the issue that I'm also raising is that what is safety any longer? You haven't made decent returns on investment in the West, government versus the private sector, over the last 20 years. The so-called risk-free rate has always been the yield on the 10-year Treasury in the United States. but that 10-year Treasury is denominated in dollars, and the dollar's been falling. So I'm not sure what's safe any longer. I noticed with interest yesterday that the private sector Chinese sovereign rating agency, Degang, downgraded the United States to an A+, suggesting that, at least to foreigners, the United States is no longer as safe as it's always been held to be in the past.
And you're also suggesting that we should be investing in emerging market debt as well as equity. Why do you say that?
Well, again, it's slightly because of the comparison to what's happened in the developed world. The developed world has a very high level of debt, and I don't think it's as safe as it's been cut out to be in the past. The levels of debt in developing countries, in emerging markets, much lower, often yielding far higher, and you're being rewarded for your risk. Someone in the Financial Times recently described emerging markets as that asset class that actually is rewarding risk properly. And I think that the distortion of things like bond rates in the United States because of QE1 and QE2 means that risk is being under-rewarded and under-reflected in prices. And in emerging markets, that's not happening to anything like the same degree. So you're getting a higher yield, and in some cases you could actually argue the risk is lower because the balance sheets of emerging markets are in such better shape than as compared to developed countries.
Dr. Michael Power, it's great to have you back in Australia again. Thank you for talking to us.
Thank you, Tiki.